Well, hello, folks. I'm LA. This is the weekly report. We're looking at the third week into the year here, and it was brutal. If you look across the board here, whatever gains people were expecting, those gains aren't happening. Massive losses. Bitcoin just as volatile or more volatile than others, even down more this weekend. Big losses across the board. You had some gains in gold, bonds, and the dollar. Year-to-date gains massive, and there's no other way to say this than this has been brutal. Now, when the market doesn't do things that you expect it to do, in other words, the odds favor certain events, then that is either bullish or bearish, right? And in this case, it's bearish. We expected bullish retest regens to hold. They did not hold on the weeklies. They should have held. That's negative, right? And there's no other way to say it. And when you look at it in that perspective, these massive losses, right, are a reflection of the fact that that did not do what it was supposed to. A lot of those losses came late in the week as it became clear that the market wasn't going to hold. And as we started to see what I believe was some forced liquidation, which we'll look at here in a second. But the liquidation was taking place. I wouldn't be surprised to see, in the next few weeks or days even, where some of that gets, is brought to the forefront. In other words, the news leaks out that, Fund X blew up or whatever it was. We're already seeing some indications that, retailers were getting hammered and some give up in those places based on Coinbase data. But, for the most part, those kinds of things come out after the fact, and I would expect that was the case. One of the ways I try to tell that is to look at what has happened on the timing of the day. And if we see, for example, the market begin to sell down hard at a particular time, that gives us some indication. And these areas here, about 3 hours left in the day, that's typically when you see margin calls begin to take place. And if they do take place, you get escalations to the downside when that happens. And it looked like that was happening on Thursday. Tried to lift on Friday, couldn't. It looks like it liquidated again to some degree Friday afternoon. I want to do a real quick recap here. As we started this year, I was fairly negative. We stayed bullish up until the end of the year. I've just summarized and put links to the things that we've talked about. And essentially there was divergences, there was underperformance, massive underperformance. In other words, the indexes looked a lot better than most stocks. Bond yields were starting to rise. Rising rates are usually an equity problem, either immediate or usually with a bit of a lag. And the warning signs were there that we could get a larger decline, and I pointed those things out. And not only did we get that, right, we even got more than that. I mean, the amount of selling that we saw, right, that looked like fear, right, instead of greed. And that, when that happens, typically you get big sell-offs, and that's, I think, what we saw. Starting with this report, I've changed up a little bit of the formatting. I'm trying to communicate better what I'm thinking. It's always a challenge, right, to get across what you're trying to say. But hopefully, maybe this type of commenting will give us a little better feed for that. I've tried various formats over the years, so anyway, this is another one, and we'll see how it works out. But I'm fully discounting the fact that the bonds, right, are already, what damage they were going to do is already being done. And we had talked about, I think it was last week, we talked about the swing point high when it came into it. It got right to it, didn't quite hit it. You're going to probably see some demand come in. And if you look over here on the daily, that is what happened. And that's not surprising. Now, some of this could have been as a result of the market selling off like it did, but also I think some of this is the market itself saying, hey, they're not going to go that crazy, right? They're not going to go to the point where they're going to take and do 6 rate rises this year, or they're going to do both balance sheet removal as well as rate increases in a massive amount. And so anyway, I think the market is starting to recognize that maybe it's a little overdone. Maybe these interest rates shouldn't be at 2%. I was kind of pegging 2%. They got about 1.95 or something. And, they pulled back as a result of that. And so that's not expected. That's kind of what we thought. And that pressure is already in the market. I think it's already discounted. I think the rate hike thing is totally discounted. This is a graph trying to suggest how much rate hikes are expected. And, the implication is they're expecting 4 rate hikes this year. Stock buybacks, these I don't think are discounted. They're a known event, but I think there's some, question of how much effect they'll have this time around. But they're at all-time highs. I mean, they were in the third quarter. I suspect in the fourth quarter they were pretty high again. And this, to me, suggests that they're going to be a positive on this market. Earnings have been a bust. I mean, if I look across my data, and I have some later, the pre-announcements were extremely high this quarter, much more so than most of the time. And I think that, along with now that the earnings are coming out, is probably reasonably discounted. It's mostly discounted in the market. This whole thing with the war drums going on in Ukraine, this is probably just priced into a partial amount. And the slowing economy, I don't think is priced in. This is a negative that's probably going to continue to be a negative. Moving to the technical side here, if you look at these indexes, and I've got, they're kind of small, but basically it's the S&P and the index over here, showing 2 different things. One is a swing point break that took place on the S&P. So this swing point here got broke. That retest region also was broken as price closed on the lows on Friday. Over on the index itself, right, this guy, the retest region failed, but that swing point low hasn't been broken. That's, why am I making this distinction? Well, when you break a retest region, in other words, it doesn't hold, and it should hold the first time back. In these cases, it wasn't the first time, and so it was likely it was going to break, which we talked about last week. But when they do break, that's a precursor usually. Sometimes it happens simultaneously, but usually it's a precursor to tell you that the trend has changed. And you've heard me many times say, okay, what was up as a result of this retest region breaking, right, is no longer up. It's sideways at best. And potentially it's turning down. Turning down in the sense of a longer term move, not right now, but that says you're probably going to get a break of a swing point. And that is what happens most of the time when you go back and look at the charts. And so we make those distinctions. We look at retest regions because they give us that heads up. And because last week we knew we were testing multiple times, we knew the odds were increasing that they in fact were going to break. And so last week we had a lot of warnings that this may happen. Now, once it happens, there's other things, right? The market's always giving you information. There's 2 things that will happen as a result of this happening, or what should happen. Short-term selling should be about done. And the bearish retest region, in other words, as we come back up now, this bar here is going to be retested on the way back up, and the odds favor it to actually push prices lower again. So in other words, you get a bounce, and then after the bounce, right, so the market's been coming down, 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 you get a bounce, then it should try and break lower again. In other words, regen lower than the price it previously set. So that's what we should expect. Now, whether it happens or not, that's a different question. And what it does do or doesn't do will tell us about what's coming next. And that's how we try and read this market all the time. Now, there's reasons to believe that more than likely it's just a bounce. One I just gave you, which is that's what the odds suggest. But there's other things that we can look at. For example, look at this. 5 swing point lows on the Russell broke on this bar last week, right? And on the monthly, it's breaking as well. Now, whether it holds or not, we'll see, because it may or may not. But that's a bad thing. It would have to rally almost 5%, 4.65, to keep this from breaking. All right, if we look at the possibilities of what may or may not happen, there's 3 of them. One is we could just keep selling off. If we do, right, I would think that the 4270, 4280 area on the S&P, another 2.5% is probably the target. And that's probably, again, in other words, if you just go straight down, right, you're going to get a more violent bounce. And so the more violent bounce would probably be what to expect. Another thing is we could just bounce from here. Now, this is probably the more likely case, but it's probably going to be just a bounce. And I would give this a target of 45.60, maybe 46.70 at best. It could be, a lot of times this comes as a 2-day kind of thing. And so, you get a hard move down, and then you get 2 days where it bounces hard and then tries to roll back over. And then, of course, it's about, does it hold that low or break lower again when it does it? Another possibility, and I would say that, this is the best possibility. These two are lesser possibilities. And that is that we just chop inside this last bar. We had a big bar down Thursday and Friday. And I wouldn't be surprised to see it try to chop inside this range if this is the case. And I've got it about 43.95 to 44.95. So if you chop, that's probably the most bearish case, because once it's through chopping, it's probably going to continue down. And what that means is that anyone that was trapped doesn't get a chance to get out, which means you're probably going to get a flush at the end of that chop when it starts dropping again. Other reasons to support these 3 things, right? And the one I'm expecting is the bounce. Here's the reasons. Stretched. I don't look at Bollinger Bands. I don't look at classical stuff very much. I like Bollinger himself, though, because he does it based on standard deviations off of a mean. And so the mean is, of course, this line here, and he does 2 standard deviations off of it. Well, when it tightens up like this, right, you can get a spike either way, and doesn't necessarily mean that it can't carry farther, right, when this gets tight. Now, when it's wide already, which this was extremely wide. When you get a push off of that, usually you're going to get a reversal fairly fast. And so that is the reasoning on that one. You got an extreme negative tick. I mean, the NASDAQ, NDX have been the ones that have led us up, and now these guys are getting hammered on the way down. Broad NASDAQ stocks have been getting hammered for 2 or 3 months, and some of them even longer. Extreme negative ticks usually says, when you get these, is that you're going to get a bounce. What does it mean? Well, it means, at any given time, there was that many stocks simultaneously trading lower on that tick. And so you don't get that very often. And you can see here, going back, there's not very many cases where you see this. This is over about a year. And so this is not what you would expect to continue to happen. You would expect it to alleviate, right, the pressure and come back up into the mean. So that's a positive. Bullish weekly indexes, the MTTFs now, they've reset. And we've been harping on this for a long time that it was going to happen. the numbers were all up into extreme measures. You still have it on the Dow, you still have it on the NDX, but everything else reset. You need that. It's got to reset every now and then, because the mean life cycle of an MTTF trend, right, the mean time failure on a trend, there's the mean, and then there's the extremes, and we were out here in the extreme. And when you get out in the extreme, that's the kind of a tell of the bell curve, and the odds are not very favorable that you're going to stay out here that long, and that's where you are when you're looking at these numbers. Now, one thing that's countering that is that you don't have the resets yet on the sectors, right? It just hasn't happened. If you look through here, you've still got some large numbers in a number of these sectors that need to switch. And so that to me says that we could get a further plunge, right, to reset these this week. The more likely case, as I was suggesting though, is that we'll get a bounce and then we'll come back down and we'll break lower, and these will all reset on that push lower. And so that's my expectation. I think it's always to have a dose of reality about what can and can't happen, because even though we expect certain things, if you're managing a fund or your own fund, your own money, you need to know, there's a point where you got to draw a line and say, okay, if it does this, I've just got to bag it, all right? I'm wrong on that trade, or I've got to take some countering action or do something. I can't just sit there. How much lower could this S&P go? Well, if you look at the charts, right, this is the demand, the highest level of demand found on the TA Today charts. That's 700 points lower, folks. That's a long way. Now, again, you have to counter that with what is across multiple things. I mean, you don't just look at one number and assume that's it. Here's the NASDAQ. It's not nearly as low percentage-wise. And so my expectation, and on the NASDAQ, there's a reason, right? Because you've got all the anchor bars in this area, right? So if we do continue lower, I would expect this is the one to pay attention to. It's the NASDAQ. This is going to tell you where the real target is on this trip lower. Now, if we're in a bear market, right, then that S&P number that we were just looking at, that number becomes more important later on. Okay, quickly switching to the fundamentals here. The hard economic data just keeps disappointing. I mean, I've said this multiple times. It continues to do this. If you look at the last set of data that came out, and I'm talking about hard data, I'm not talking about, expectations type stuff. Jobless claims missed. New York Fed, not Fed, but the Manufacturing Empire Manufacturing Index missed very badly. Earnings reactions, they've been extremely negative. 5 bullish out of 30 plus, almost 50 I track, over 50. So 22 negative, 25 sideways, and most of them end up in this bag most of the time, right? So you'll have, again, if you have a curve, most of the sideways are sitting here, and then you have some bearish, and then you have some bullish. This time it's skewed, right? A lot more bearish than bullish. You got some big earnings this week. Given the reset that's already taking place, I think they're probably discounted. And so I'm talking about Microsoft and I think it's Apple, Microsoft. There's 3 of them this week of the big 5. And so those probably discounted, probably going to be favorable. Got the Fed meeting. I think that is fully discounted. Matter of fact, I think they could surprise us by talking dovish. We'll also have some durable goods in the GDP number. This is probably going to be a reflection of what I've been talking about up here. I think I didn't actually put on the GDP, but I think that's partially discounted already. So a quick bottom line of where we're at here. I think that a bounce is probably the most likely case, and potentially it could be a snapper rally, I like to call it. It could be a big one. The best case is that divergence, expected best case is that divergence that we talked about last week where the index holds. That did happen this week. In other words, we broke everywhere, but the NDX held. Although it's always possible, there's a risk of a crash. I still think that's a very small risk straight away here. If we come down, get a bounce, and then start breaking, right, we'll have to start to reevaluate. But I do expect right now this is the case we're going to see fairly soon, either immediately this week or sometime this week. That would be my expectation. The crash thing, we'll leave that on the table for later and look at it as we evaluate as things go on. I think a V-shaped rally is extremely low. I mean, we have seen so many of these over the last decade, given the Fed monetary easing and nonsense that's going on for so long, and the fact that a lot of the cycles have been destroyed. I don't think they can keep doing it. Matter of fact, one of the things that's fascinating to me right now is that so many people still view this as a likely case. I don't think so. Eventually it's going to fail. We don't have the Fed pouring money into the pot anymore. We don't have fiscal deficits being expanded. Yeah, they're still huge, but they're not being expanded. This stuff is gone. Earnings, they're not doing what they need to do to push this market higher. All this stuff is, these are fundamental things. They're not going to see, unless the Fed completely flips again, right? We're not going to see a V-shaped rally. So as to what I'm doing, we stopped out on some positions this week. We're about 63. We were 70 last week invested. I stopped out on a couple, added a couple more back. As you know, we got some short positions in the mix. And now trying to catch a snapper rally. We took a hit last week. We were positive until last week. But, you do what you do, and you set up for the next trade. And, sometimes they work, sometimes they don't. So you have to keep working them. Additional exposure. If we get that snapper rally, I probably will try and add to that exposure that I've already outlined. Finally, the weekly prognostications, worst case, most likely case, those are what we've seen so far. No best cases. That's pretty interesting, huh? And here's another change that I made. Usually I just put lines in here, but I'm trying to think of a way to better show, again, what I think the boundaries are and what I expect to happen. And so this, hopefully, I'll keep playing with this, but this gives us some indication. So the red, of course, is worst case, which is a break of a swing point low, although by the end of the week, I don't think it will end there. And so what I'm saying is that the prices that you see here, the expected prices, by the end of the week, this is where they should end. And if we draw that line across, you can see that that line is above that swing point low. So I don't think we're going to break another one. What's the most likely case? Well, the most likely case is you're testing back into the swing point low, or you have tested into it by the end of the week and drop back below it. That's not good. That's a regeneration down, or an attempt to regenerate down. Best case, I don't think we can get above that. I think this bar is going to kill it on the way back up. And so that would be best case up around 4,600. And that's it for this week, folks. Have a great one. Stay safe, and I'll see you next time.